Chapter 6 focus on closing entries and preparing what is known as a post-closing trial balance. So we have now come to the end of the accounting cycle, which is a series of steps that take place during the accounting period where we take our everyday business transaction and turn it into useful accounting information. So we've covered steps 1 through 6 in chapters 4, 5, and 6. We're going to now focus on step 7, learning how to journalize and post closing entries. We have a new account title in chapter 6 known as the income summary account. This account is a special owner's equity account. It is only used during the closing process to summarize the results of operation. In essence, the income summary account is used to close out our revenue accounts and our expense accounts. And I'll explain that in further detail. So what happens is that the income summary account is a temporary owner's equity account. Because the account is temporary, it too will be closed out during the closing entry process. This account does not have a normal balance on the debit side or credit side. This account will show whether we had net income or a net loss for the accounting period. This account has to be closed out given a zero balance at the end of the accounting period in order to prepare for the upcoming accounting period. So we're going to see how the income summary account is used during what's called the closing entry process. So you ready? Let's go. There are 4 steps in the closing entry process. The purpose of this process is to close out all of our temporary accounts. So the revenue account is temporary. It's going to be closed out to the income summary account, which means the balance in the revenue account will be transferred to the income summary account during the closing entry process. Your expense accounts are also temporary, and their balance will be transferred to the income summary account as well during the closing entry process. Then the income summary account is going to be closed out during the 3rd step of this process. The income summary account will show whether we had net income or a net loss for the accounting period. The income summary account will be closed out to the owner's capital account. And in the 4th step, we're going to close out the owner's drawing account. The balance from the drawing account will be transferred over to the owner's capital account. So I made up an acronym REID, R-E-I-D, which identifies the 4 steps of the closing entry process. During this process, we're going to close out our revenue accounts, close out the expense accounts, close out the income summary account, and close out the drawing account. So REID identifies the 4 steps of the closing entry process. Let's get to it. Here we have a worksheet for Eli's Consulting Services, and we're focused now on our revenue accounts because the first step of the process is to close out the revenue account. Fees income is our revenue account. It is showing a credit balance of $47,000. Your job is to get fees income to a zero balance. Perhaps you're saying, how am I going to accomplish this task? Well, let me show you. So right now, fees income has $47,000 on the credit side. Your job again is to give the account a zero balance to close the account out. In order to do that, I need to debit the amount that would give the account a zero balance. So if I debit the account for 47,000, the account will now show a zero balance. But you know that if you debit one account, you must credit an offsetting account. The account we're going to credit is going to be the income summary account. So in step one, I'll debit fees income, credit income summary for $47,000. At the end of this first step, my revenue account is now showing a zero balance, and the account is now ready for the upcoming accounting period. Next would be the actual journal entry. So when it says closing entries, that means recording to the general journal. So I'll debit fees income 47,000, credit the income summary account. Okay. We write the word closing entries in the journal description column. That is to describe the types of transaction that we're about to post into the general journal. Next, you will have all of your expense accounts. So take a look at the worksheet. We had salary expense, utilities, supplies, rent depreciation. These accounts all have a balance shown on the debit side. Your job is to credit each expense account the amount required to give the account a zero balance. So I'm going to credit salary expense, 8,000, utility expense, 650, supplies expense, 500, rent expense, 4,000, and depreciation expense, $183. I'll credit each account the amounts required to give each account a zero balance. Once again, if I credit these accounts, I must have an offsetting debit. So add up the amount of all of your expenses, and we're going to debit income summary for the total of all of our expenses. At the end of this second step, all of our expense accounts will now have a zero balance. So in our general journal, we're going to debit the income summary account, and we're going to credit each expense account the amount required to give each of them a zero balance. So now you've completed half of the steps in the closing entry process. We closed out our revenue accounts first, and in step two, we just closed out all of our expense accounts. The third step is to close out the income summary account. Before the account can be closed, you must first determine what is the balance in the income summary account. In step one, we credit the account for $47,000, and in step two, we debit the account for $13,333. Therefore, the income summary account is currently showing a credit balance of $33,667. Perhaps you're saying, what does that $33,667 represent? What you think? I'm waiting. You are correct. This shows the net income that was earned for the current accounting period. The 47,000 showed total revenue. The 13,000 showed total expenses. Therefore, we've earned net income of $33,667. Now, the income summary account has to be closed given a zero balance. So now what we're going to do, we are going to debit the income summary account, $33,667, to now give that account a zero balance. It's closed out to the owner's capital account, so we credit capital for $33,667. And it makes sense, because how does net income impact your capital balance? it will make your capital account increase. The capital account increase on the credit side. So in my journal, we're going to debit income summary, credit capital, the $33,667. 3 steps down, 1 to go. The last step is to close out the drawing account. From the worksheet, the drawing account has a debit balance in the amount of $5,000. The drawing account will be closed out to the owner's capital account. So think about it. Your job is to give the drawing account a zero balance. To accomplish this goal, we're going to credit the drawing account for $5,000 and debit the capital account for $5,000. The drawing account will now have a zero balance. We have transferred the withdrawal amount over to the owner's capital account. And it makes sense because how does a withdrawal impact your capital? It will make the account decrease. The capital account is going to decrease on the debit side. Okay? So once you record this transaction, you would debit the capital account, credit the drawing account in the amount of $5,000. Now notice that the capital account still shows a balance at the end of this process. And that's because the capital account is a permanent account. It's not temporary. And for your permanent accounts, their ending balance will transfer it over to the upcoming accounting period. But if the account is temporary, like the drawing account, it's going to have a zero balance at the end of each accounting period. Okay? So here is a summary of the 4 steps of the closing entry process. Step 1, we close out the revenue accounts to the income summary account. Step 2, we close out our expense accounts to the income summary account. At the end of these first 2 steps, your revenue accounts and your expense accounts, they now have a zero balance. In the third step, we close the income summary account to the owner's capital account. You're simply transferring the net income or net loss for the accounting period over to the owner's capital account. And in our fourth and final step, we close out the drawing account to the owner's capital account. So at the end of this process, your revenue accounts, expenses, income summary, and drawing will all have a zero balance. Their amounts have been transferred to the owner's capital account, which is a permanent account. Therefore, REID, R-E-I-D, represents the 4 steps of the closing entry process. In our second video lecture, we're focused on how to post these journal entries into the appropriate ledger accounts and how to prepare what's known as a post-closing trial balance. Okay? All right.